Today, stress testing has become the flagship macroprudential regulation in nearly every region, creating hypothetical and real-world, idiosyncratic and systematic distress for the entire financial sector. Stress testing as a regulatory exercise takes on many forms and names. The US is by far the most advanced and burdensome in terms of stress testing regulatory requirements, namely the Comprehensive Capital Analysis and Review, or CCAR, and the Dodd-Frank Stress Test Act, DFAST, for banks and large financial institutions. Similarly, in Europe, the EBA has launched quantitative bottom-up initiatives to assess the EU bank solvency. The UK has also followed suit with the concurrent stress testing exercises. And there are numerous other regulators across the world that have come up with similar exercises, from the Bank of Japan to even different organizations such as the IMF. The long list of acronyms used in all these stress tests can be summed up in short as putting financial institutions through hypothetical scenarios to measure their crisis response strategy, and also their financial metrics under those preconceived scenarios. Specifically, they measure two things. The first one is capital and asset values. The second thing is funding and liquidity. In the US, stress testing is the most advanced for firms going through CCAR. In CCAR, regulators use the output to assign firms an object or non-object grade. So that means that CCAR stretches beyond just a mere capital management exercise. The Fed actually uses it to understand and grade firms on risk management processes, governance structures, modeling capabilities, and senior management and board of directors risk acumen. In Europe, regulators have tried to run several stress tests and what they call asset quality review programs, but they were faced with significant pushback from firms, since some of these firms kept on failing these exercises. So this year, they've come up with an innovative idea. They're going to run the stress test, but nobody's allowed to fail. Now, in order to understand how firms can reach operational excellence in stress testing for regulatory compliance, and to even go further than that by leveraging stress testing as a crisis and risk management response tool, as well as a daily decision-making business tool, we must begin by understanding the broader picture and then breaking it down into smaller piecemeal bits for analysis. This is more commonly known as a hybrid top-down and bottom-up exercise. Firms that practice a top-down only or bottom-up only approach will find it difficult to reconcile failures and deal with live stress events as they materialize. This is evident in Lehman Brothers stress testing, risk management policies, practices, and procedures. Let's take a look at some of the main pillars of stress testing. This is according to the stress testing blueprint that we've come up with in our most recent report. The first one is risk management strategy. The second thing is the governance of the stress testing exercise. The third aspect is the project management part of stress testing. The fourth one is data management capabilities around stress tests, which then sits within the systems and infrastructure building blocks of stress testing. And then you have the modeling components where you run the data through. Seventh is effective challenge, which ties us back into governance. And then we have quality assurance, which is a subcomponent of project management as well. And then finally, use of the stress testing results. Based on a recent study that we conducted, many financial institutions struggle to see how these pieces of the blueprint fit nicely together. There is a very heavy emphasis by financial institutions, software vendors, and management consultants on the technological factors, including data, systems, infrastructure, and the modeling components. And what they're trying to do is really standardize these stress tests. Now, however noble these efforts might be in order to help firms alleviate some of the stress testing pressures, they are only a part of a greater whole. Firms that don't capture the people and process factors of stress testing will be unpleasantly surprised and disappointed as they operationalize the exercise and/or face real-world stress events. Although I'd like to discuss this entire blueprint in great detail, for the purposes of this short video, I'll focus on what surveyed firms cite as challenges across 4 dimensions. If you want more information about the rest of this blueprint, you can visit our website and the OPMUS Risk and Public Policy portal and download the report. So the first challenge is lack of strategic vision, which has a number of subcomponents under it. So the first one is having a lack of a central governance point, resulting in sporadic coordination and accountability across the firm, which means that nobody really owns the stress testing exercise. Second thing is that few executives in business units utilize stress testing and scenario analysis in daily decision making because they don't understand how to use the output of this stress test. The next thing, under lack of strategic plan in stress testing, is that stress testing has historically, or not historically, but ever since the regulatory exercises came out, have been solely used for regulatory purposes. They use a classical check-the-box compliance approach to stress testing, instead of using it as a decision-making tool, which surprisingly, before the 2008 crisis, it was used for just that. The next thing is ambiguity around translating the regulatory requirements of stress testing. The next bucket of challenges for financial institutions in stress testing is coming up with adequate risk mitigation strategies. Many institutions miss holistic views of risk management as they develop their stress testing frameworks. They also have a classical siloed risk management organizational approach, which requires a paradigm shift with respect to risk culture and governance. Different regulators, such as the Federal Reserve Bank and our own experience working with these institutions, shows a weak risk identification process while conducting stress testing. The next thing within this same bucket is that stress testing frameworks have limited to no linkages with risk appetite. The next bucket of challenges is around designing stress scenarios. Most institutions are struggling with developing stress testing scenarios that strike the right balance between being comprehensive and real. Similarly, they overlay the scenarios and the models used within the exercise excessively without proper justification. The next thing within scenario development is that scenarios are typically not even plausible, and in some cases are too weak as a result of a flawed scenario development process, which we'll get into in just a bit. The next bucket is analytics and modeling. So models are typically as good as the data that you use to build them. So data limitations and availability of granularity of the data actually makes it really hard to come up with macroeconomic relationships between the different variables in the models. The next thing is lack of portfolio-specific and regional data, which also makes it very difficult to segment the models. The next thing is around model infrastructure and run, which are not done in an orchestrated and cohesive manner. Finally, probably the most disturbing thing is that some firms still don't have formal standards for model validation and model development. Now, it's imperative to have both formal policies and procedures for model development and validation. As we'll see in the next few minutes, there's a fundamental chicken and egg problem with respect to risk management strategy and stress testing. Because firms have faulty risk management strategies to begin with, it makes it an extremely overwhelmingly onerous exercise when it comes to stress testing. Firms that fail the qualitative component of the stress testing exercise do so largely because of deep-rooted strategic risk management shortcomings and a flawed enterprise risk management framework. Similarly, firms that struggle to aggregate and create a cohesive stress testing framework and strategy find that it is as a result of those deep-rooted flaws in the broader risk management strategy. In order for stress testing to be successful, its framework must be built upon the firm's actual risk management strategy, not an off-the-shelf stress testing framework that is temporarily put in place to mask those deep-rooted failures in risk management processes and procedures. Enterprise stress testing is a new discipline. That means that it's regarded as a highly technical one, which makes it incredibly difficult to immediately embed in a firm's risk culture. Therefore, firms that are going about this exercise must revisit their overall risk management strategy and frameworks in order to pivot them for stress testing purposes. Firms must restructure the risk management strategy with the following paradigms in mind that are typical of risk management strategies. So the first thing is around identifying and categorizing risks. And this is done in order to understand where stress testing failures might happen in terms of a real stress event. Second thing is around assessing and measuring these risks in terms of the models and systems that are used to assess the risks that you've identified. Next is around reporting, managing, and monitoring the risk. And this goes back to the governance framework, which we'll get to in just a bit. Risk identification should be the starting point of stress testing. Practices we've seen typically only look at the scenario generation process as a siloed activity, divorced from risk identification. Firms that use this strategy might arrive at a scenario that seems real, but will fail to construct scenarios that are comprehensive and truly address the firm's vulnerabilities. Best practices dictate that firms must begin with a directory of risks to determine what their internal risk anatomy looks like. We've observed a wide range of practices in designing risk management strategies that enable stress testing. Most commonly, firms that are successful recognize that the risk identification process should be based on business units, portfolios, and client composition. The approach requires enterprise data aggregation efforts that are costly. However, it is an investment that firms cannot afford to miss. From these risks, we should categorize multiple buckets based on risk types for assessment and measurement. Risk assessment and measurement should be done through models and systems as defined in the F building block you see on the slide behind me. Beyond what we will discuss later under the modeling section, special attention must be paid to qualitative risk concentration and dividing up systematic and idiosyncratic risks, which cannot be done via algorithms in most cases. A firm's risk management strategy must include methods for assessing and measuring qualitative risks that are not otherwise captured through models. Once risks are identified, categorized, assessed, and measured, firms must manage and monitor them. This is an inseparable aspect of stress testing. That is, firms must understand and monitor their risk tolerance and risk appetite closely and develop scenarios based on these risk management building blocks. They should do this to understand how the firm would respond to an idiosyncratic and systematic event differently. Finally, scenario development is the final essential tool for successful and actionable stress testing. In order to develop comprehensive and real scenarios, firms must revisit their risk management strategy and design a framework with the goal of balancing risk management, compliance, and stress testing initiatives. Next up is governance. The simplest definition of governance that we can use in the context of stress testing is doing the right things and doing the things right, which is typical of any governance exercise for enterprise risk management. The role of the governing bodies is to ensure the firm is engaging in the right activities at the right times utilizing the right people at the table. As mentioned in the previous section, risk management strategy is the strategic discipline of intelligent decision-making based on a set of possible outcomes as a result of risk identification, categorization, assessment, measurement, and monitoring. The governance model that firms employ is largely the decision and decision-making structures that are involved in the stress testing process. To date, a number of governance models have emerged that span from using a sign-off system to even committee systems where people vote on different things. Regardless of the method of preference, the criteria to choose the correct governance methodology should be based on efficient and enforceable governance, nimble and efficient governance, and a transparent and repeatable process. Policies and procedures must be up to date and also articulate and define roles and responsibility and accountability structures for the stress testing process. In constructing policies and procedures, firms must ensure there's alignment and coordination in stress testing activities between different business units within a firm. So, for instance, finance, risk management, and the various business units that the firm has. Finally, policies and procedures must be realistic and enforceable in streamlining across the aforementioned teams. Stress testing reporting should be overseen by senior governance bodies, including but not limited to a capital committee, something like an asset liability management committee, any strategic risk committees, audit committees, and board risk committees that the firm might have. And it should be overseen by the overarching board of directors. The most effective way is to design tracking metrics and dashboards on the progress along the different aspects of the stress testing blueprint, including scenarios, models, model risk management, different policies and procedures used in risk management, personnel, action plans, project management. Something that's very important to include in there is effective challenge. And finally, the use and monitoring of the stress testing results and including it in the risk appetite and tolerance. As the board of directors and C-suite ventures to take a driving seat in the stress testing process, they must be conscious of some of the most common fallacies that we see in the decision-making process around stress testing. The first one is overconfidence, which is really the tendency for a firm to overestimate their ability to navigate severe turmoil markets and withstand severe idiosyncratic events. Next up is focusing, which is another bias that is a prevention bias occurring when firms place too much importance on one aspect of an event. So for instance, that could be rising interest rates or falling interest rates, which causes error in accurately predicting the utility of a future outcome and what the domino effect might be on different aspects of the scenario. The next one is false consensus, which is the tendency for firms to overestimate the degree to which other firms employ strategies that might otherwise be aligned with their own, and that clients will also stick it out with them if a crisis happens, and that there won't be a bank run if there is a crisis. The next one is present bias, which is a tendency for firms to manipulate capital levels, data, models, and scenarios to pass the regulatory exercise. These firms typically overestimate the immediate rewards of passing the stress testing exercise at the expense of understanding what the long-term implications might be if a real scenario were to materialize. Next up is project management. Project management and stress testing is one of the toughest pills to swallow, second only to the governance process that we went over. The interconnected nature of the stress testing exercise makes it difficult to dictate who in the firm should own the project management aspect of stress testing. Many firms have established new stress testing departments to handle the project management aspect of stress testing separately. Firms must take into consideration various activities, timelines for completion, potential roadblocks, interdependencies, and all the teams involved in the stress testing decision-making process. That might include things like committees, the quantitative folks working both on the model development and model validation side, the business units that you're supposed to get the data from and apply the use of stress testing from, data teams, IT teams, external consultants is another big place for project management, and then finally the third line of defense, which is audit. As evidenced through the logic of the stress testing blueprint, there is significant overlap between governance and project management. Once the governance structure has been established with clear accountability process, then project management can be delegated to an internal team or an external consultancy. Some firms rely purely on external consultants. Others rely on internal project management offices to undertake the stress testing project management activities. Optimus believes that an internal team should drive project management and stress testing. This team's full-time roles and responsibilities will be dedicated to stress testing, analogous to a crisis response team at non-financial institutions. By having the team focus on continually stress testing the organization, they become intimately familiar with breakdown in data, analytics, and other aspects of the firm, and can help firms uncover vulnerabilities and cope with live events in case of tumultuous market events. However, firms should beware that a project management structure divorced from the governance process that we went over is of little added benefit. Practice makes perfect, and while there's no such thing as a perfect stress test, since firms can never really predict how markets are going to behave, practicing with multiple runs of stress testing will enable the project management team to be ready for any real market event if one were to materialize. In addition, it helps the firm use stress testing as a business as usual activity, similar to the way a firm that runs any of its risk models on a regular basis. Another common topic of debate is whether the stress testing exercise should be owned by risk management or finance. Ultimate accountability of stress testing within the regulatory context typically falls with the board of directors. It's delegated down to the chief risk officer and chief financial officers. All stress testing and risk-related activity should fall with the risk management, with the chief risk officer's accountability structure and his risk management team. Similarly, all the subsequent capital planning activities, stress testing uses, and financial planning that's based on the stress testing output should be within the chief financial officer's accountability structure. And there should be significant cooperation between the two, and that should be the job of the project management team and the governance structure to determine how that plays out. The next challenge in stress testing is effective challenge. Effective challenge is a term that was coined by regulators, and it's the process by which a firm has a dedicated set of independent individuals reviewing stress testing outputs, inputs, models, and assumptions. There are two distinct types of effective challenge. The first one is qualitative effective challenge, which is really making sure that scenarios, the capital plan, the assumptions and limitations of the models, and the overlays, for instance, make business sense and are representative of the firm's overall strategy, business lines, portfolios, and clients. The second type of effective challenge is quantitative effective challenge, which is really making sure that data, models, analytics, systems, and all other technological aspects of the stress testing exercise are independently verified and subject to effective challenge and testing for errors, and that firms understand their limitations. Ultimately, effective challenge should be conducted and mandated by the firm's governance framework. That is at the highest level by the board of directors, which then delegates the responsibilities to capable individuals with knowledge of the firm's overall strategy, business lines, portfolios, clients, models, data, and day-to-day operations. Today we see use of stress testing results as one of the most commonly debated topics amongst regulatory circles. To date, regulators have mandated using the stress testing exercise for capital and liquidity planning purposes. However, on multiple occasions, they've signaled to the industry that they should be using stress testing beyond ticking the box regulatory compliance exercise and arriving at the right capital levels under times of stress. OPIMUS, through its most recent study, recommends that firms should use stress testing for the following purposes in chronological order based on their internal capabilities. First one is obviously regulatory and compliance exercise, since you can't afford not paying your clients dividends based on a pass or fail decision from stress testing. Second thing is around capital and liquidity planning based on the hypothetical scenarios that might materialize. Third thing is around contingency and resolution planning for financial institutions. The fourth is risk appetite and tolerance setting, which is again a subcomponent of the overall enterprise risk management framework. The fifth is around strategic planning for the firm under multiple scenarios. The sixth, financial planning under multiple scenarios. If a firm has the capability and know-how, they should also utilize stress testing activities for further risk management value-added activities such as portfolio management, credit origination strategies, and even beyond risk management in things like acquisition and divestiture strategies. To conclude, I hope that I've conveyed an overview of how to take a holistic approach to stress testing and have adequately clarified the various moving parts and how they move together. As stress testing becomes more stringent and firms increasingly rely on it to understand their capital, liquidity, strategic, and risk vulnerabilities, we must realize that there is a fundamental chicken and egg problem between risk management strategies and stress testing. You simply cannot have good stress testing practices without starting off with good risk management practices. If you'd like to find out more information, please download the latest report on stress testing from the OPIMUS Risk and Public Policy portal. Thank you.